So, good morning. Again, this is Francis Kadiwan, and today we will continue our discussion on accounting for inventories. Our topics for today are number one, the inventory accounting systems. Next is the cost flow assumption, and finally, costing formulas. So to start with, let's discuss inventory accounting systems. So inventory quantities and costs may be accounted for using either the periodic system or what we call physical system. And the other one is the perpetual system. Under the periodic system, a company does not maintain continuous record of the physical quantities or costs of inventory on hand. It determines the quantity of inventory by conducting a physical inventory at the end of the period. So movements in inventories are charged to nominal accounts such as purchases, purchase returns, purchase discounts, and freight in. So a company using the periodic system does not maintain a continuous record of the physical quantities or cost of inventory on hand. Therefore, the company will not be able to determine its inventory accurately until a physical inventory is taken at the end of the period. So, kailangan magkaroon ng count at the end of the year for the company to be able to determine how much inventory, if there is any, will be presented in the statement of financial position. Okay? So, under the periodic system, all acquisitions of inventory are charged to the purchases account. And then separate accounts are maintained for purchase returns, allowances, purchase discounts, and freight in. And then the net cost of purchases is the sum of purchases and freight in and reduced by purchase discounts, returns, and allowances. Okay? So, the periodic inventory system, itong system na to is appropriate for relatively low value but numerous inventory items, particularly when the cost of a perpetual inventory system are likely to outweigh its benefits. So, itong periodic system, mas magandang gamitin kapag low value, maliliit lang na halaga, pero maramihan. Kaya ang normal na gumagamit ng periodic system ay mga grocery stores, 'di ba? Napakaraming goods pero um, relatively low lang naman yung value per unit of the goods. Next, perpetual system. So, under this system, a company continuously tracks changes in the inventory account. That is, all purchases and sales of goods are recorded directly in the inventory account as they occur. At the end of the period, because the inventory account is updated, no adjusting entry is necessary to set up the ending inventory. So, for perpetual system, a company using this system maintains a continuous record of the movement of the items in its inventory. Such system is essential when management wants to maintain effective planning and control over inventory. So, companies maintaining inventory items in small quantities with high unit costs usually adopt this method. So, yung mga nagbebenta ng cars, di ba? Onting inventory lang pero malalaki yung halaga. The purchase or production and use of each item of inventory are recorded in detailed subsidiary records either in units only or in both cost and units. For perpetual inventory system, all movements in the inventory are charged to the inventory account. So for purchases, we debit the inventory account. For sales, we credit the inventory account. For purchase return, we debit the inventory account. For sales return, for purchase return, we credit the inventory account, and for sales return, we debit the inventory account. So all movements in the inventory are charged to the inventory account, merchandise inventory account. And because of that, the inventory account is updated, and therefore, no adjusting entry at year end is necessary to set up the ending inventory. But the question is, a company using perpetual inventory system, for companies using perpetual inventory system, do they need to conduct physical inventory at year end? Kailangan pa ba nilang mag-count? The answer is yes. So, for companies using perpetual system, they still need to count because sometimes there are variations between the physical count and the ledger balance um, of the inventory because of, say, probably errors in recording, shrinkage, breakage, waste, and other causes. So, ginagamit natin yung physical count, yung physical inventory at year-end para lang ma-check natin yung balance ng ating inventory account at year-end. Okay? Now, what do we do if there are discrepancies? Magkaiba yung inventory control account, yung account na ginagamit natin for the movements of inventory, and the physical inventory. Hindi nagtali. So, we have this account, inventory shortage or overage. So, ginagamit natin siya to record the discrepancy. So, if the actual count, the physical count, is lesser than the inventory control account. So we debit inventory shortage or overage and credit inventory. And then kung mas marami naman, we debit inventory, we credit inventory shortage or overage. So we use that account for either the function of expense method or the nature of expense method of preparing the statement of profit or loss. But if the company is using the function of expense method, meron pa siyang isang choice, which is to use cost of sales. So, pinapasok sa cost of sales ang shortage or overage ng inventory. Now, let us try to compare the journal entries for these two accounting systems for inventory. So, the periodic system and perpetual system. For purchase of goods, we debit purchases and we credit accounts payable or cash, whichever is applicable for the periodic system. So, we use the purchases account. Whereas in the perpetual system, since the inventory account is affected when we purchase goods, so we debit the inventory account and we credit accounts payable or cash. For purchase returns, we debit accounts payable and we credit purchase return in the periodic system. But for perpetual system, we debit accounts payable and we credit the inventory because if there are purchase returns, meaning binalik natin kay supplier yung goods, our inventories will decrease. For sales or sale of goods, in the periodic system, we debit accounts receivable or cash and we credit sales. For perpetual system, we will do the same. We debit accounts receivable and we credit sales plus the entry to record the changes in inventory or the change in inventory. So since pag sale, our inventories are to be removed from the books, the recognition of inventory yan, sales. So we credit inventory and we debit cost of sales. That's our additional entry for the perpetual system. Now for sales return, in periodic system, we debit sales return and we credit accounts receivable. And in perpetual system, we do the same again. We debit sales return and we credit accounts receivable plus, again, the movement in inventory. So we debit inventory, sales return, bumalik sa atin yung goods, and credit cost of sales. And to record the year-end adjusting entry to set up ending inventory and to close beginning inventory, in the periodic system, we debit inventory end to set up the ending inventory. So that's the account and amount to be presented in the statement of financial position. Yan yung unsold units during the year. And then we debit cost of sales. So we set up cost of sales. So yung mga nabenta during the year, yun yung debit sa cost of sales. So complementary accounts yung dalawang yan, no? Unsold inventory and sold cost of sales. And then anong partner niya sa credit? Credit tayo inventory beginning. Kaya nga closing of inventory. So yung inventory beginning natin during the year were closed or was closed by crediting the inventory beginning account, and we also credit the purchases account. So essentially, kung titingnan ninyo itong mga account titles na to, sila yung bumubuo sa total goods available for sale Anong ulit yung formula natin sa total goods available for sale? We have inventory beginning plus purchases. So our inventory beginning, unsold units last year, plus our purchases this year will be our total goods available for sale this year. Kaya inventory beginning plus purchases, total goods available for sale. Another formula for total goods available for sale ay inventory end and cost of sales. So saan ba napupunta ang total goods available for sale? We have inventory end for unsold units and cost of sales for sold units. Okay? For perpetual system, we need not prepare that entry. Why? Because as I've mentioned a while ago, our inventory account is updated because all movements in the inventory, in our inventory, are recorded using the inventory control account. Okay? Now, for shortage of inventory or overage of inventory, so difference of the perpetual record and the physical inventory. Naka-perpetual tayo pero nag-count pa din as internal control to check whether the balance of the inventory control account is correct. So, nag-count. And then merong difference. So, we record this entry in the perpetual system with debit inventory short or over if there is short and we credit inventory. Shortage, yeah? And if there is overage, we debit inventory and we credit inventory short or over. Now, for the periodic system, walang ganyan. We did not prepare that entry. Why? Because wala tayong mini-maintain na account dyan. So, wala tayong mapagkukumparahan if we are conducting or if we conducted physical inventory at year-end. So, kung ano man yung kinount natin, yun na yung inventory natin. Wala tayong i-compare sa kanyang inventory control account. Okay? So, to illustrate the inventory accounting systems, perpetual and periodic accounting systems, let us have this illustration. So, Start Trading had the following transactions during the current year. So, beginning inventory, 100 units at 6 pesos per unit. Purchases, 900 units at 6 pesos. And sales of 600 units at 12 pesos. The physical count at year-end indicated 350 units at 6 pesos were on hand. So, check natin. Tama ba yung physical count? So, 100 plus 900, that's 1,000, minus 600, that's 400. So, the should be ending balance of our inventory is 400, but the physical count indicated that there are only 350 units at year-end. So, what are the entries using the periodic system and perpetual system? So, for the first transaction, which is the purchase, so for the periodic system, we debit purchases. That's 900 times 6, 54, and we credit accounts payable or cash. And then for perpetual system, we debit inventory. We debit our inventory account and we credit accounts payable or cash. Now, for the sale of the 600 units in the periodic system, we debit accounts receivable and we credit sales for 7,200. That's 600 times 12. And for the perpetual system, we debit accounts receivable 72 and we credit sales for the same amount. And to record the change in inventory, so we credit inventory for the cost, which is 900 times 600 times 6, that's 3,600, and we credit cost of sales for 3,600. So always remember movements in the inventory are recorded at its cost. And finally, to record the adjusting entries at year-end. So for the periodic system, we close the beginning inventory and the purchases account. So we credit beginning inventory for 600. Yun yung binanggit kanina, 100 units at 6 pesos. And then we credit purchases account, which is 5,400. And then we debit inventory end. That's 350 times 6, 2,100. And we debit cost of sales. Sino yung cost of sales? 600 times 6, 3,600. And for the perpetual system, since there is a discrepancy between the inventory record, supposedly, di ba, it should be 400 times 6. But per physical inventory, it's only 350 times 6. So a difference of 50 units at 6 or 300 pesos. So we debit inventory short or over 300 pesos and we credit inventory for the same amount. Okay? Okay, so after discussing the inventory accounting systems, let us now discuss cost flow assumption. So, a primary issue in accounting for inventories is the determination of the amount to be recognized as an asset and the amount to be recognized as an expense. So, as I've mentioned a while ago, no, we have first the beginning inventory, so unsold units last year, and we add the net purchases this year. Kasi alam natin na yung beginning inventory ay kukulangin para ibenta natin this year. So what we do is we add um, new inventories. So we purchase additional inventories para idagdag natin sa ating beginning inventories. And if we combine these two, we have the total goods available for sale. So beginning inventory plus net purchases, we have the total goods available for sale. Now, this total goods available for sale, at cost ito ha, lahat ng inventory ay at cost. So the cost of the total goods available for sale is allocated between the cost of goods sold. So, ang una niyang pinupuntahan ay cost of sales kung nabenta yung inventory. And the other one is the ending inventory kung unsold. Now, the question is, which of the total goods available for sale or which of the goods available for sale um, are recognized as an asset and recognized as an expense. So, sino doon sa mga available for sale ang mapupunta sa cost of sales at ang mapupunta sa ending inventory? Yun ang kinikwento sa atin ng cost flow assumption. So, the flow of the goods from total goods available for sale to cost of sales or to ending inventory. Okay, so that's the story of cost flow assumption. And with that, we have the cost formulas. Now, for our cost formulas, IAS2 inventories provided three formulas. So we have a specific identification, first in, first out, and weighted average. The choice whether we use a specific identification, first in, first out, or weighted average depends upon the nature of the goods or the items of inventory. So if the inventory items are not ordinarily interchangeable and goods or services produced and segregated for a specific project, we will use a specific identification. So yung mga hindi nagkakapalitan kasi hindi naman magkakaparehas, we use a specific identification. Say for example, in the case of condo units or condominium units, di ba? There is only one room 301, di ba? Sa third floor, first room, wala nang ibang 301 sa third floor. So say for example, sa third floor na merong 10 rooms and then 301 was sold and then the other 9 rooms were not sold. So only the 301 will be reported in the cost of sales. The other 9 rooms will be reported as ending inventory. So specifically, we can identify which among the goods was sold and which among the goods remained unsold. Now, for goods or items of inventories which are ordinarily interchangeable, we have a choice whether we use the first in, first out, or the weighted average. First in, first out, or FIFO method of costing inventory is based on the assumption that costs should be charged against revenue in the order in which they were incurred or they were purchased or they were manufactured. So yung unang binili, unang ginawa, unang ibebenta. So the inventory remaining is measured based on the most recent cost. So yung mga natira, meaning sila yung mga huling ginawa or huling binili. Kaya sila yung mas malapit sa current cost or recent cost. Whereas for weighted average, so this method considers goods to be undistinguishable or ordinarily interchangeable and are therefore valued at an average of the cost incurred. So ang ginagawa natin dito is we compute the weighted average unit cost. So total goods available for sale ang numerator over um, total number of units available for sale. So meron tayong kinocompute, pre-computed na weighted average unit cost. At yun yung minomultiply natin for the goods sold na papasok sa cost of sales and ending inventory na papasok sa statement of financial position. Okay? So specific identification of cost means that a specific costs are attributed to identified items of inventory. Whereas FIFO assume that the items of inventory that were purchased or produced first are sold first, and consequently the items remaining in inventory at the end of the period are those most recently purchased or produced. Whereas under the weighted average cost formula, the cost of each item is determined from the weighted average of the cost of similar items at the beginning of a period and the cost of similar items purchased or produced during the period. Okay? And now to illustrate the three cost formulas that we just discussed, let us have this illustration. So, Seawater Company had the following inventory transactions in 2020. So, on January 1, we have a beginning balance of 250 units with unit cost of 10.50 each. On March 7, we purchased 200 units at 11 pesos per unit. And then on May 20, sold 120 units at 14 pesos per unit. And on June 30, sold again 55 units at 15 per unit. And then on July 15, we purchased 275 at 11.75 per unit. And finally, on September 17, we sold 250 units at 16 pesos per unit. So determine the cost of ending inventory, the cost of sales, and the gross profit using the three cost formulas. Okay? So first, we will answer the problem using the specific identification. So for specific identification, the problem must specifically identify which among the units were sold during the period. So for a specific identification, we have this additional assumption. So assume that the May 20 sales originated from the March 7 purchase. So yung May 20 sale na 120 units were from the March 7 purchase na 200 units. So yung cost of sales natin ng May 20 sale is 11 per unit. And then June 30 sales from January 1 balance. So yung June 30 na 55 units from January 1. So ang cost of sales natin ng June 30 sales ay 10.5 each. And then the September 17 sale were from July 15 purchase. Yung binenta natin ng September 17 na 250 units were from July 15, which were purchased at 11.75 per unit. So to compute for the ending inventory, we'll have this solution. So first, ilang units ba ang natira? So we have 250 beginning plus 200 purchases. And then we sold 120 and 55. And then we have another purchase of 275 and we sold 250. So our ending inventories are 300 units. So saan manggagaling ang 300 units na ito? First, yung January 1 natin na 250, may natira ba dyan? Yes. Ang January 1 daw, ang nabenta lang dyan yung June 30 na 55. So out of 250 units on January 1 balance, 55 were sold. So the remaining units for the January 1 balance is 195. And then the unit cost for the January 1 balance is 10.5. So 195 times 10.5 is 2,047.5. Next, for the March 7 purchase, ito yung pinanggalingan ng ating May 20 sale. So out of the 200 units purchased on March 7, 120 were sold on May 20. So we have a remaining 80 units for the March 7 purchase at 11 per unit. So 80 times 11, we have 880. And then for the July 15 purchase, we have 275, and then sold on September 17 ay 250. So may natirang 25 at 11.75 per unit. So that's 293.75. So 25 times 11.75, 293.75 plus 880 plus 2,047.5. Our total cost of ending inventory, 300 units, is 3,221.25. Next, for our cost of sales. So our cost of sales, ilan ang ating binenta? May 20, 120 units, June 30, 55 units, and September 17, 250 units, a total of 425 units. Our May 20 sale of 120 units came from our March 7 purchase, which we purchased at 11 pesos per unit. So 120 times 11, that's 1,320. And then for the June 30 sales, galing sa January balance at 10.5. So 55 times 10.5, that's 577.5. And finally, the September 17 sales were from the July 15 purchase at 11.75. So 250 times 11.75, we have 2,937.5. So total cost of sales were 4,835. Okay? And finally, for our gross profit. So for gross profit, we compute first our sales. So this time we will use our selling price. So for the May 20, that's 120 times 14. For June 30, that's 55 times 15. And for September 17, that's 250 times 16. Our total sales, 6,505. Our cost of sales is 4,835, and therefore our gross profit is 1,670. Okay? Okay, so now let us discuss the same problem, but this time using the FIFO cost formula. First in, first out. So again, we will determine the cost of ending inventory, which is at 300 units. The cost of sales, which is at 425 units. And our gross profit. So first, cost of ending inventory. So, di ba, as we mentioned, we have a 300 units of ending inventory. So, kung first in, first out ito, ang una nating nabenta ay yung nasa unang balance, January 1, at yung sumunod na purchase na March 7. So, kung may matitirang 300, if there are remaining inventories of 300 units, practically, saan siya manggagaling? So, the 300 units will be coming from our July 15 purchase of 275 units, and the remaining 25 will be coming from our March 7 purchase. So, again, our cost of ending inventory will be from the July 15 purchase of 275 units at 11.75, plus the remaining 25 para mabuo yung 300 will be from our March 7 purchase, which is at 11 pesos per unit. So 275 times 11.75, that's 3,231.25, plus 25 times 11, 275. So our total cost of ending inventory is 3,506.25. Okay? Next, for our cost of sales, which is at 425 units, so sabi ko nga, sino ang una nating ibebenta? Yung unang binili. So, for the 425 units sold, first, that's from January 1 balance of 250. So, 425 minus 250, it's 175. So, yung natitirang 175 will be from March 7 purchase. So, our solution for our cost of sales is first, the 250 units from January 1 times 10.5 unit cost. is equal to 2,625 plus the 175 from the March 7 purchase, which is at 11 pesos per unit, 1,925. So our total cost of sales is 4,550. And now for our gross profit, we just deduct the 4,550 cost of sales from our sales, which we've already determined in the previous illustration. So 6,505 sales less the cost of sales of 4,550, our gross profit is 1,955 for the first in, first out cost formula. And now let us solve again the same problem, but this time let's apply the weighted average method. Okay, so for the weighted average method, as I've mentioned, we will determine first our weighted average unit cost. And our formula for the weighted average unit cost is total goods available for sale over the total units available for sale. Our total goods available for sale is 8,056.25. Paano natin yan kinompute? That's lahat ng purchases including the beginning balance at unit cost. So 250 times 10.5 plus 200 times 11 plus 275 times 11.75. Total of 8,056.25. So yan yung total cost of goods available for sale natin over total units available for sale. Sino yung total units available for sale? That's 250 January 1 balance plus March 7 200 and July 15 275. Total of 725 units. So 8,056.25 divided by 725 units, our weighted average unit cost is 11.11. And this amount will be used in determining the ending inventory and the cost of sales. For ending inventory, we will just multiply the 300 units of ending inventory and our 11.11 weighted average unit cost. So our cost of ending inventory is 3,333 pesos. Now, to determine our cost of sales, we will just deduct the cost of ending inventory from the cost of goods available for sale. So, cost of goods available for sale is 8,056.25. We deduct our cost of ending inventory, which is 3,333. Then our cost of sales is 4,723.25. And for the gross profit, we have the same formula. We will deduct the cost of sales of 4,723.25 from our sales of 6,505. Therefore, our gross profit is 1,781.75. And finally, we will solve this same problem using the other method under the weighted average cost formula, which is what we call the moving average method. Moving average method or the perpetual system method requires the computation of new unit cost after each purchase, and subsequent issues are priced at the latest average unit cost. Kaya siya tinawag na moving average kasi every time that the entity or the company will purchase inventories, new unit cost will be computed. So may unit cost na bago every time merong purchase. Okay? So for our complete solution for the ending inventory cost of sales, we will have this table. So for January 1, we have 250 times 10.5. That's our beginning balance, so 2,625. And then on March 7, we purchased 200 units at 11, total of 2,200. So since merong purchase, we will compute the new unit cost. So how do we determine unit cost? Total cost of 4,825 divided by total units available for sale of 450. So our unit cost is 10.72. So that's our new unit cost. Next, on May 20 and June 30, magkasunod naman silang sale. So pwede na natin silang pag-isahin, 120 and 55. Magkano natin siya ibibenta? Base siya doon sa new unit cost natin. So 175 times our new unit cost of 10.72. So cost of goods sold on May 20 and June 30 is 1,876. Therefore, after the sale, we have 2,949 balance. How many units? 275. So that's 450 minus 175 units sold. So again, as of June 30, we have 275 remaining units at 10.72 per unit. So total cost of inventories, 2,949. And then on July 15, the company purchased another inventory. So 275 units purchased. So that means we will have to compute another or the new unit cost. So 275 times 11.75 purchase cost per unit. That's 3,231.25. And therefore, after that purchase, our total cost of inventories is 6,180.25 divided by the total units available for sale. That's 275 plus the purchase on July 15, which is also 275. So we have a total of 550 units. So 6,180.25 divided by 550, our new unit cost is 11.24. And then on September 17, we sold 250 units. At what amount? At 11.24 din yung cost. So 11.24 times 250. So cost of units sold, 2,810. Therefore, on December 31, our ending inventory is 3,370.25. That is 300 units times 11.24. Okay, so our ending inventory is already reflected or given in the computation. That's 300 times 11.24 or 3,370.25. And then for our cost of sales, we will just add the May 20, June 30 cost, which is 1,876, and September 17, which is 2,810. Class, always remember this one ha. In the moving average table, the amount which will be used in the computation for the sold units is not the selling price but the new unit cost. Kasi ang pinag-uusapan natin dito is the cost of goods sold or the cost of sales. So when we say cost of sales, we are not using the selling price, rather the unit cost, yung new unit cost. So for May 20 and June 30, we use 10.72 instead of the 14 pesos or 15 pesos selling price. And on September 17, we use the 11.24, not the 16 pesos selling price. So our cost of sales for the year, 1,876 plus 2,810, 4,686. And then for gross profit, so same formula, sales of 6,505 less cost of sales of 4,686, our gross profit is 1,819. Okay, so that's part 2 of accounting for inventories. Again, in this video, we discussed our inventory accounting systems and our cost formulas. Thank you.